Had you invested 5,000 rupees via monthly SIP in an average performing equity diversified fund in the past 15 years, you would have made a corpus of 29.42 lakh rupees. We are talking about real numbers here. Your investment for the entire period would have just been 9 lakh rupees. You would have earned an average SIP return of 14% during this time. Surprised? Here's more. Had you doubled this SIP amount to 10,000 rupees, you would have accumulated 60 lakh rupees. And this money would have smoothly crossed a crore had you extended the investment period to 20 years. And mind you, here we are just talking about an average one. I believe you can imagine what kind of corpus the best performing fund would have built for you. Don't worry, you don't have to run your imagination. We'll tell you, but in some time. Hello and welcome to our channel 5 Minute Finance by ET Money, where we talk about the basics of personal finance. We have two other channels, ET Money Hindi, where you can watch all these videos in Hindi. And if you are looking for some analytical and slightly advanced topics on investing, you may go and check out our other channel, ET Money. Now you must have come across such big and dreamy figures in many videos. But today in this video, we are going to help you to invest your first 5,000 rupees or 10,000 rupees or any amount that you are comfortable with in mutual funds. So don't skip any part of this video. We'll also try to answer all the possible questions that could arise in the minds of a new investor. If you are beginning your investment journey, there are three mutual fund categories you can look at. Number 1, equity-linked savings schemes, ELSS funds. Number 2, large cap index funds. And third, balanced advantage funds. So first category is ELSS funds. Now this is a diversified category of equity mutual fund which comes with a tax benefit. So if you are a new investor and are looking at tax saving under the old tax regime, you may consider the equity-linked savings scheme, also known as tax saving mutual funds. The USP of these funds is that they help investors save income taxes of up to 46,800 rupees under Section 80C every year. They come with a lock-in period of 3 years. They invest at least 80% of the funds in equities, and the fund manager can decide how much to invest in large cap companies, mid-sized companies and small companies. Now let's look at the most interesting part, their returns. So the average returns of ELSS funds in the last 5 years have been around 15.98%. The average 5-year SIP returns stood at 17.5%. Impressive, right? But which are the best funds in the ELSS space? Well, we'll get into it a little later in this video. These funds choose from the top 100 companies to invest in. So if you are investing in large cap index funds, you are basically investing in relatively the most stable companies of the country as compared to the mid and small companies. Large cap companies are well established and have a proven track record. So we can say that these companies are less affected by market fluctuations and economic downturns as compared to the mid and small caps. So this makes them comparatively lower risk. In the last 5 years, the average returns of large cap index funds have been around 13.5%. The average 5-year SIP return stood at 14.93%. Now, these funds invest in a mix of equity and FD-like instruments, what we call debt instruments. The fund manager keeps on changing the equity and debt mix according to the market conditions. Now, understand it like this. Theoretically, when the market is going up, the fund manager can move to buy more equities to increase the gains on investments. But in case the stock market falls, the fund manager can book gains and move to debt. This will cushion the losses. Isn't it the best of both worlds? And over the last 5 years, balanced advantage funds have given an average return of about 10.41%, while the average 5-year SIP return stood at 11.75%. Now coming to finding the best funds in these categories. Well, for that, simply go to the ET Money app and tap on the fund category of your choice, and that's it. Each fund under the category has been assigned a rank. Now, ET Money rankings are based on the consistency in terms of returns and volatility. Similarly, you can find out the best funds in any category of your choice. You can also find a detailed 360-degree view of any fund on the app. It is like the fund's report card, which tells everything about the performance of the scheme. For more details on this, you can watch our other detailed video, Mutual Funds for Beginners. You'll find the link in the description. Now let's move on to the next set of questions to clear your doubt about making your first investment. So should you invest in all these categories? How many funds should you select in all these three categories? Can you pick any one or any two categories? How to do that? Let's clear the air quickly. It's simple. Decide your needs and accordingly choose the category. Like, if you are looking for tax saving under Section 80C of the income tax, your first choice should be ELSS funds. So invest 5,000 in one or at max 2 ELSS funds. But if you are not looking for tax saving and want to keep things simple and just want to start somewhere, you can go for large cap index funds. Now, based on your need, you can also choose one fund from ELSS category and one from the large cap index category. Another case could be where if you are a new investor not looking for tax saving and are not comfortable with a pure equity fund, you may opt for dynamic asset allocation funds. They can be a great choice for investors who tend to panic if the stock markets fall. So depending on your needs, you may select any one category or a combination of two categories to invest. If you want to invest 5,000 rupees per month, you may be fine with one or can go with up to two funds at the most. Reason being, 5,000 is too small to be divided and invested in several funds. It will create clutter. And don't forget, a mutual fund scheme itself is diversified. So if we talk about an equity fund, on an average, a scheme has around 40 to 70 stock in its portfolio. Plus, it may have some debt portion as well. Now, if you increase the investment to 10,000, you can still continue with two funds in your portfolio. In fact, even when your portfolio reaches a few lakhs, you do not need more than 4 to 6 funds to invest. Well, if you are smitten by extraordinarily high returns in mid-cap and small-cap funds, hold your horses. Usually, these categories are not recommended for a new investor because they invest in medium-sized and small-sized companies and they carry much higher risk than the categories that we have discussed. But don't lose your heart. What you can do is start investing in the categories that we have discussed earlier in this video, gain some knowledge, and once you get a taste of it, you may start to build your investment portfolio. But that's a task for little later. For now, you should not delay your investment. You can go to the ET Money app where you can invest in any mutual fund of your choice at 0% commissions for absolutely free. That's a wrap. We hope this video would help you invest your first 5,000s or 10,000s or any amount of your choice in mutual funds. Thanks for watching. If you have any questions, you may ask us in the comment section. Also, do not forget to hit the like button and subscribe to our channel.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.